Hello, Mark Sturdy here with a summary this week of the 23rd of September of our work with 7 days ahead. And if we look at the summary page, you'll see that we remain big bulls of the S&P 500. We are bulls of the Nikkei 225 and we are bulls of gold. Those are the clear trending markets, the hot markets that are pushing all in the same direction, both in the short, medium and long term in the charts. Let us start though with our first usual reference point, which is the dollar euro, and to point out that we remain in the long and medium term bears of the dollar, bulls of the euro, as you see here with our old arguments that have been going for some time. But the pause since June mean that we have, and the failure to break up last week and sustain a close above 118.29 suggests that we should be a little more cautious. We still think the underlying pressures and forces at work are for a weaker dollar, but we want to see a close above 118.29 before we can back the trend, which we believe firmly to be intact. But we want to see more evidence before we are short-term bearish of the dollar. Sterling is even less strong against the dollar. I mean, we are trending better. We have pushed up into this area of resistance, historical resistance, where the market has failed to get above 1.4, 1.4.5, failed 3 times. Let's see if we can get up. We're a bit more cautious on sterling. The market is still intact, but there is possibly, I put it no higher than that we have on the verge of completing for sterling, a weakness against the dollar, a bear rising wedge. So a breakthrough this diagonal might send us down at least to test 132.07. In short, sterling is a little more weak against the dollar than the euro. The euro is pausing. There's a little more weakness in sterling, so much so that, for example, in the sterling euro, sterling is now looking weak and poised to break down through 114.38. It's bounced twice before that. If it were to break down through that, there'd be further selling of sterling against the euro. Let's go to the market that we are hot and remain hot, which is the S&P 500. Here's the big long-term trend. Here's the medium-term trend, bouncing off the 63.35 very neatly, and indeed the short-term trend bouncing, pausing beneath 65.80, forcing its way up, an attempt to pull down, very quickly reversed. The market's bullish and trending strongly. We remain bullish. The same is not true of the Euro Stoxx 50. It's clearly staggering and holding beneath the 55.24 very, very long-term prior high, and indeed above the short-term prior high, 55.75. This is a continuation chart, hence the levels. This is slightly anemic, I've described as price action. This is the December 25 future, and that too is close, but not through these levels. And I think we need to see that market push up through those levels at least before we can start getting excited. Here's the detail in the December chart. Stand back and watch and wait for a break up through 55.25. FTSE, well, we've been bullish for a long time, and it is under the influence of this continuation head and shoulders, but it's obviously not, it's relatively anemic relative to the S&P. It's pausing, going sideways. For the moment, we're standing clear of that. And we are, on the other hand, very bullish with Nikkei 225, as that, unlike the Euro Stoxx, has broken up through this big prior high, 39,600, spectacular breakup. The end of September would confirm that in the quarterly chart, but we feel confident that nothing is going to be reversed in the next 8 days or so. And in any event, the medium-term chart is more than sufficiently convincing for bulls to get excited. We're in the grip of this triangle, we believe, driving it up, and we think minimum move up to 49,000. We're only at 45,000 now, so more to go, and very exciting for the bulls. Nothing much in bonds. The point about most of these bond markets is that they're within very large trading ranges, and here we have even closer trading range, And there are movements within the range, but none of them are compelling and tell a very exciting story in terms of aligning the short, the medium, and the long term all in the same direction. This looks to be a large triangle in the Bund. Were that to break above 302, that would be exciting. Until then, we're in this range here, and the range, the smaller range there. Gilt of the three markets is the most interesting because, notwithstanding the fact that it's within a range, we still think there's scope for this market to come on down here. Oh, I'm so sorry. The gilt market. We have this completed triangle and the consolidation beneath the end of the triangle, the lower boundary of the triangle. And the mirror of this in the yield chart is the smaller triangle within the larger triangle, slightly different. In any event, this is close to breakdown through this level and indeed this level here. Look more closely, you'll see that it's a triangle that's failed, but looked at more carefully using closes, we could still say it's intact. So we remain bearish of price, bullish of yields in the gilts, lacking immediate sense of breakout, but that's the big picture. Oil, we think is very vaguely bearish, breaking out of this trading range here, tried to re-enter it and failed. Look at 61.26 for a catalyst for more oil selling. Gold, we're outrageously bullish for, even though it's gone way beyond its targets in these rather large charts. It continues to create more formations and patterns and complete them, and therefore sustain its bull energy, even though these are on a far smaller scale than these old ones. It's in the grip of the completion of this bull triangle. Further to go. Thanks very much.